Hi, my name is Keegan Rezek and welcome to the Lending Alliance. Since your interest rate will determine the cost of your loan, it's important to carefully consider your options. And if it's at this point you're starting to panic a little, there's no need to. Rest assured that your broker, that's me, will help you understand your options and how they'll affect you in the real world. Because short of having a crystal ball to predict the future interest rates, it's crucial that you consider your own financial goals and commitments as part of the decision process. Because you want to be making an informed decision that you're comfortable with. Starting off with variable interest rates, it's important to understand that your interest rate can change, and if it does, so too will your repayment. Being at the mercy of market forces means there's always a level of uncertainty, but you're probably thinking, surely there's some benefit, right? Well, there is. Flexibility is the key here. You can make unlimited additional repayments, allowing you to pay off your loan early. Access to offset accounts, which is always very handy. You potentially can have access to a redraw facility. It's also less costly to change lenders when you might need to refinance elsewhere or pay out the loan due to the sale of a property. And now that we have a feel for variable rates, let's move on to fixed interest rates. The interest rate is fixed for a specified time, which is usually between 1 to 5 years. Repayments will remain constant until the fixed period ends, at which point you'll usually revert back to the standard variable rate of the lender that you're with, or you have the option to fix your home loan again. But please note that there are limitations to your loan account under a fixed rate, namely no offset account in most cases. You're limited in the amount you can make as additional repayments during that fixed period, and if you do make those additional repayments, normally the maximum is about $10,000 to $15,000 per fixed rate period, you actually can't redraw those funds until the period actually ends. Lastly, you can also potentially incur break costs if you pay out the loan early or you refinance elsewhere. Now, those fees will be determined as at the time you actually need to action it. Whilst there is no guaranteed way of predicting rates, you need to weigh up your options and see how it fits within your circumstances. I actually want to discuss 2 or 3 options with you to give you an understanding of maybe the thought process behind the scenario and how you're kind of matching it. Now, in the first one, let's look at a first-time investor that's very risk-averse. They like to budget all their life expenses, so a fixed interest rate would probably give them that certainty and peace of mind that they're looking for. In the second option, we have a couple that's purchasing a property with the view to renovate and then sell in a short time frame. So here, variable interest rate makes sense so that they can easily pay out the loan once they sell it without having to incur expensive break costs. Now, thirdly, we have a couple, they're having a child in the next year or so. Fixing their interest rate would allow them to ensure they can cover all the necessary mortgage costs plus the impending costs associated with having a newborn. As with all things home loan related, you shouldn't be looking at what your neighbours and friends are doing. Instead, you want to get the right advice from informed professionals that will help you look at your own set of unique circumstances. And with that said, if you need any further information on what I've discussed in today's video, please feel free to contact me directly on my mobile 0451 668 673. Or if you feel more comfortable, drop me an email, keegan@tlagroup.com.au, and I'll be sure to answer any questions that you might have. Thanks for tuning in to today's video. I'll see you in the next one. Bye for now.